Okay.
All right, so that wraps up our session with quantum reservoir impacts. Next, we have Joseph from JDM Capital Corp. Will be presenting crypto's impact and application in future commercial real estate transactions. Joseph, are you here with us today?
Yes, I am. Can you hear me?
Yes, we can.
Okay. Good afternoon, everyone. Thank you very much for taking the time today. Thank you, Michael and team over there, for giving me the opportunity to chat with everybody. Just a couple of quick things. Kevin, by chance, did you get that quick little presentation? I'm not sure if you can pop it up or how I might be able to.
Oh, do you have it loaded on your computer?
Yeah, it's not gonna work on my side.
Oh, okay, all right.
Yeah.
Give me 1 second. Do you want to take your time to just briefly introduce yourself?
Absolutely. The president of JDM Capital Corp, and we're out of New York. Our focus is on real estate transactions, and mainly here in the U.S., and looking at opportunities that exist and kind of discussing things that are going on in regard to the possibilities and applications of cryptocurrency and real estate, which to date mostly have not necessarily met their optimal fruition. But I just wanted to, kind of just cast out, first of all, the information, opinions, commentary. We're not here to pitch for any cryptocurrency for any type of transactions that we're doing. We're just merely giving a viewpoint briefly in regard to what we see as far as, the industry and what's going on. Any analysis, projections, estimates that we're talking about, or any references to things that I mentioned are, as you'll see in the disclosure that's here, subject to, uncertainties and qualifications. And I'm not here to pitch or sell anything specifically. It's more about a market commentary from a segment of hard asset that has been, has kind of tried to be able to make its breakthrough into the cryptocurrency market. And it's been, so far has not been necessarily bridged completely across the success, except for minor instances and either extremely large transactions. So definitely I refer everyone to the disclosure. And the contents of anything I'm discussing should not be construed as investment, legal, tax, or other advice, discussions of any matter or company or investor. Investment doesn't deem an endorsement or recommendation of any type. So just a little general disclosure for us as a company. Our focus, as a company in general, is to be able to find transactions in that are generating current income, preservation of capital here, and everything from mainly in the hospitality and commercial asset side, and lightly from the multifamily side. But a lot of what we do has to do with those two type of assets. And we're expanding asset management in regard to helping other assets, trying to be able to find other paths of liquidity, which is where we kind of started off in regard to finding ways for us to assist and help other investors and other institutions that are looking at this. So, the topic for today is, crypto, its impact and application for future commercial real estate transactions. And that's kind of a key component in its future. There's things constantly moving and changing in this particular market segment. And I think that that's part of what makes it a complicated area for real estate. Within the last couple of hours, I'm not sure if anybody saw, it was announced just from Reuters that China bans all financial payment institutions from the cryptocurrency business. So that's an important factor of seeing the volatility of cryptocurrency along with a hard asset such as real estate. So you've got the illiquidity combining and competing with the volatility. Where there is an opportunity, there could be a bridge for opportunity. There is definitely things that we need to be able to look at and pay closer attention to, where governance and regulatory factors are, I think, a necessity. So there's been a few different real estate acquisitions and raises specifically that other companies have tried to be able to achieve for the acquisition side of real estate through cryptocurrency. And the ones that are at least US based have not really gone off very successfully. And that's mainly because of the lack of institutional support over the last few years for that. And that might be changing, especially with the rise of the altcoins and the alt investment strategies that are out there. So you're hearing a lot of noise that are out there, whether it's, Elon Musk talking about, his adaptation of the Dogecoin and what may change there. I think that's an exciting piece of the market. And I think that that's where I started off, I would say, cleanly, starting as a cynic about the crypto market, and one that was that took a bit of time to come around. But in the last couple of years, especially, seeing the evolution of it and its missed opportunities of where it's made its successes and gotten close to success in its failures. And a lot of that has to do on the effectuation of that side, which I'll talk about in a moment. Excuse me. But things like Elon Musk are, is very exciting to see, because I think that his ultimate goal is effectively to get as close to possibility in recreating a new PayPal of cryptocurrency. That's what I really think that his ultimate gamesmanship is, and what he's looking to be able to try to do. And trying to find an ESG component to it by having it be a bit greener in regard to the components of things that are solving for total coins versus solving for total work, which I'm not going to teach people who are probably on this line already, the baseline of regard to the cryptocurrency differences. But the energy component to it is is something to pay attention to. The outlined concept to say that the fiat currencies and what it costs to be able to operate that, yes. But I think that that's not a fair comparison in regard to looking at something that's only a $2.5 trillion market to something that is more of a $250 trillion market as a global currency move. So what are the benefits for tokenization in regard to real estate, and why would people be looking at it? I think that the opportunity is where number one is to take illiquid assets and and create opportunities for whether it's private equity funds or individual investors to find a pathway to a nearer term liquid event in a generally illiquid asset. And that's done through fractionalizing the ownership of those transactions. Before I get too deep into that, I would definitely say one of the things that are, I would say that's a longer term, if I brought into the concept, I'm talking about commercial real estate transactions, things that are consumer-based real estate transactions, such as people buying homes, I think are a bit further off in regard to happening because of governance and regulatory components that still have to come into play. You still have heavy dependence on title insurance and the need for title for those transactions to effectuate themselves. And I think that that's something that's going to take a bit of time. But I think that the commercial transactions may get there sooner. I think that if you bifurcated the opportunity in real estate tokenization, you would look at it from the component of equity and the component of debt. And I think that the components of finding an equity component, an equity use for tokenization in real estate is going to come across much quicker. And I think that that's going to be something that have more heavily utilized sooner than you will from just a strict debt component in acquiring real estate, which can happen. But I think when you look at the governance issues and the regulatory components of KYC and original sources of dollars to be able to be tracked is going to be a bit more challenging. But I think that the ultimate concept of, if looking at pathways through commercial real estate transactions, you're going to find that through the commercial side of equity fractionalization, creating more liquidity in illiquid components to real estate as the first kind of threshold of more of a volume-based opportunity. Those are, you've traditionally had a lot of upfront large capital requirements to acquire assets, both in equity and debt. And from an equity side these days, where you've had a more diminished role of commercial lending, whether it's in hospitality or whether it's in commercial office components and development components. I think that the early stage interest that was in looking at tokenization, and the reason that it failed on the larger, broader aspect of institutional interest was because the market that was there was very disinteresting and looking more like a dump truck setting off assets than it was of quality assets being able to be assessed and actualized like that you would find from, let's say, a REIT investment. If someone was looking for that type of unique exposure to real estate with a more readily available liquidity component to it. So the interest of the investors in fractionalizing also brings into the component that smaller investors can be have an opportunity to own extremely minority interest in deals that maybe they weren't able to previously. I believe that there's a operating efficiency broken down into the components of from everything from underwriting to actual transacting the transaction. Tokenization can bring a value from another, again, a way of looking at multiple opportunities for accessing or leveraging cash flow and generating that ability to alternate uses of cash flow. I think that there's an opportunity for the value for the reduced transaction administrative costs going forward in commercial transactions. And that includes also the utilizing the blockchain ability to store documents and transactions in that methodology and having them recalled at that value. And I think that the value of bringing enhanced liquidity to real estate, I think, is the most exciting component to the overall access that can happen. So part of who's utilizing cryptocurrency today and how is really about the surrounding services and revenue components of real estate. There's a company that's in the United States, they're in the public realm. So, well, their announcement is in the public realm, is the Kessler Collection. And what they did is they started taking a cryptocurrency for payments for hotel rooms. And they were the first of that kind, and partnering up with one of the exchanges to be able to allow that to happen. It was a fairly recent announcement, so we'll see how that kind of starts to pan out. But it's a step towards a much more broader impact to commercial use of cryptocurrency within real estate transactions. There's also been companies out in the West Coast in California that started to take cryptocurrency as a path for payment of rental payments in commercial properties. I haven't seen it adapted to the use of multifamily, but I have seen it in regard to a few companies testing and utilizing it, which is an interesting aspect where you're trying to be able to bring office users back to commercial real estate and having a component of smart space that, like as it exists out in California, and having technology companies that are components there to find another way to be able to, rather than cash, to pay their components of rental factors. It may be more efficient for certain companies, and that's another way for people to utilize another idea to lease up vacant commercial office spaces by coming up with another way for people to be able to pay. So the potential for the market is really tremendous. And what I see in that potential is the fact that the key piece, the key exciting piece, is that where you can have private transactions having an ability to be able to have more liquidity. And as those gaps in the regulatory framework start to shrink themselves, I think that you're going to see tremendous more adaptation. The sustainability of it really relies in regard to standardizing what is a accepted form of transaction, how that transaction is effectively cleared, and how the fiat currency is going to, and traditional banking relationships going to either compete, because one of the things that are out there that you're seeing, other than Goldman Sachs also starting their own crypto desk, there is exploration for individual banks creating their own coin currency. That would be more of a securitized security coin, which has not been a very overly utilized type of coin. And I think that that would create some additional sustainability, but change the dynamic in regard to necessarily who can be able to access that. So I think that in the longer term, it's going to be a very sustainable opportunity. It's going to be an opportunity for a movement across now where you have obvious inflation impacting people's real estate transactions and underwriting. And it's going to be in an evolved process of thinking to say where normally a flight to real estate is a hedge towards inflation. And now people asserting and looking at cryptocurrency as an opportunity to be able to utilize that as a hedge towards inflation. How the combination of these two are going to be able to be interacting together is an exciting opportunity, and its sustainability is still within a range of question that's not necessarily answerable today. But I think that's something that's going to be in need of being watched very closely, because I don't think it's inevitably, I don't think it's an impossibility. The reality of crypto being a form of utilized transactional asset is not going away. It's going to remain. It's already creeping in through the revenue channels of rent and room rates. I think that it's been utilized for other outside services that we've seen, from construction to third-party maintenance and other vendors, and that's going to continue to be able to grow. And that's how we see it from that perspective and what we think is going to happen. I see that there's some questions popping up. Kevin, is there anybody to answer yet along the way? I don't want to make sure that we don't, because I have a short window of time, I want to make sure that we're kind of capturing anybody that we should.
Not yet. Well, there is one question about if there's a chance for them to receive your presentation after this presentation.
Yeah, we'll definitely make whoever's emails us, we're happy to be able to share whatever we think in regard to our, what we're rolling out here.
Mm-hmm. And if anyone has questions, please submit your questions to the Q&A box. Yep, and Joseph, I'll let you know if any questions pop up.
Excellent. So, as we see it, again, as this is an initial exploration for us in regard to its adaptation. I wouldn't say that we're seeing tomorrow transactions happening, and again, I would say that the institutional need for support for larger commercial-based transactions here in the United States, for sure. There was an UPREIT transaction that was done in the UK that was successful for student housing. That was an interesting aspect. There was a transaction that was done in Brooklyn, wasn't really fully disclosed in regard to how they utilized it, but we know that it happened there for a residential project. And there was other projects that were happening that we've seen in New York that didn't fully bring themselves fully across. So we see that the fractionalization is, number one, an opportunity. We see that the operational efficiencies that could be created for everything from dividend distribution to listing more information out there about a more volume amount of assets, offering a part liquidation for positions or full positions of assets. It would create a reduced settlement time. Transactions would be able to effectuate themselves much quicker in a tokenized kind of structure than it would. Normally you see that it could be on a fast track of anywhere from call it 90 to 120 days. By the time that all of the legal and other pieces of diligence that are done, it would allow a lot of preloading of data transparency for the diligence to be out there and not necessarily recallable, because once it's on the chain, it's out there. I think that flexibility that fractionalization offers in the individual investor to look at things in a much more diversified way, and the ultimate concept of liquidity are the highlight parts of where we're seeing that happen.
So on that topic of fractionalization, someone's asking, do you necessarily need crypto for the tokenization and fractionalization of commercial real estate?
The answer is that it is that's a good question. I think that it is a more efficient manner for fractionalization. There's people that are out there that are doing crowdfunding and so forth, but I think that that doesn't avail itself to the same level of potential liquidity. You can go and buy and sell tokens fairly readily and easily, and that enables, whether it's the promoter sponsor to be able to create that position, to take partial improvements, enhancements, and an earlier liquidity than anticipated, which most of the real estate transactions and investments are anywhere from 3 to 10 years, especially these days from the things that we're seeing, as well as the need for those improvements that could be during that life cycle. Let's say if it's a property improvement plan for a hospitality asset. So that was a very good question. Thank you for that.
All right. So our next question is, why would a tenant want to pay their rent in cryptocurrency? What's in it for them to do that?
So if what's in it for them, again, we didn't make this decision. It's another company that did. I think that we see the advantages for a landlord, but a tenant might do it if they're actually in the technology business. So the idea was that there's a lot of vacancy, especially in California and New York and some other major cities, for the office business, and obviously due to the pandemic. And the idea is trying to get people back to the office. And if they themselves are, in the technology business of creating coins or being able to acquire them, and they see that this is an efficient way for them to be able to do that. You think of an example of security. If a landlord was willing to accept a pledge of security, whether it's now through a letter of credit, that letter of credit perhaps could be something that's backed by cryptocurrency if there was a banking support to it, and that would be way more efficient for a tenant, where your USD is locked into itself ad valorem, where you can be able to utilize the appreciation of that, or the risk is in the landlord's hands for that security. And also the lease contract, you would be able to, as a tenant, be able to negotiate a range of difference. So, using the concept of only for example purposes, if you were going to pay your rent in Doge, and utilizing the concept that it's approximately 50 cents to the dollar today, and rent was $1,000, you'd be able to pay that in 2,000 Doge, but you'd be able to have your lease constructed that it's within a percentage of swing, so it's not forever. So the landlord might have the ability to take that aspect of risk. If 2,000 Doge today is 2,000 Doge today is that cost of $1,000 for that rent, and you've got a 5-year lease, and Doge goes up in value, the landlord can make money, and if it goes down in value, the tenant is at benefit. Maybe it's got a floor. So you could create a very unique lease that you normally wouldn't see in a US dollar created structure. So, that's one way as a potential opportunity if that landlord, and you wouldn't see this not that we've seen in a vast majority amount of assets, but I think that if you're looking at single tenant occupancy assets that are vacant, and this is an opportunity to take a risk versus, not knowing when a tenant can come to the table, I think it's a shared upside downside opportunity for landlords and tenants. If you looked at a retail transaction where a landlord leases out a pad in a retail location, but has a participation in the revenue of that tenant, which happens if it's over a specific point, you would design something similar to this opportunity for that same aspect of the purchase of cryptocurrency being paid for rent. So if somebody's renting out $1 per square foot because they anticipate the tenant's going to make millions of dollars in rent, and that landlord may share above a base 15% or 3% over everything over a particular base, you can use the same imagined construct in regard to the valuation of cryptocurrency. So hopefully it gives a little bit of a unique aspect of what you can potentially do, even for vacant retail.
Awesome. All right. So we don't have time to go over all the questions, but if you do ask, we will send it to Joseph, and Joseph will contact you personally. Is that okay, Joseph?
Perfectly fine.
Yeah. All right. So our next question is, I just completed a mortgage refinancing that took 8 months and lots of paperwork. Is there any movement towards moving the proof of home ownership to the blockchain and or mortgage underwriting directly on the blockchain?
So it's everything. The answer is D. It's in discussion. There's nothing that's going to touch today the consumer market, in my opinion. Not to mention that Title insurance in and of itself is a requirement of the fiat-driven banks, and it's a $15 billion a year industry in and of itself. So I don't think that it's going to race to find another solution. The answer is the capability there to create solutions that will create efficiencies for that person who just had that issue? The answer is yes, on the blockchain, it is possible. The governance surrounding how that happens is where we need time to be able to see how that effectuates itself. The capability is there, but the investor KYC, the compliance, the legal enforcement of that legal ownership is where laws need to kind of catch up with itself, and as well as the process of commercial due diligence surrounding it. The last thing I would throw in there is how accounting is going to handle it from that aspect, and the complexities that are going to now be laid upon mom and pop accountants to kind of deal with these circumstances for consumers that are going to now start to utilize this as a potential efficiency driver.
Awesome. All right. So I think this might be our last question. How do you see ownership entities being structured? Will it take on a standard GP LP structure? Will it be direct ownership of the asset or ownership of the governing entity?
So is this in regard to the ultimate real estate transaction, and what do I see that's going to be? What is that structure going to look like? So I think that the structure is going to look very similar at day one. But I think that it may have opportunities that are driven by the specific crypto. So you have example, again, not an endorsement, but strictly an example, ones like SafeMoon, where they burn a certain amount of crypto and there's an allocation back to a limited partner structure and sharing in that. There was a speaker earlier today that was talking about the concept of fiat-based banks that are utilizing deposits and not necessarily getting the benefits to the depositors. I think that the enhanced concept of a commercial transaction would open the capability for more shared risk and upside for investors in that kind of chain. You may see things in the future that might be crypto REITs. You might see things that are PE funds that are going to have liquidity opportunities through an exchange or partnering with an exchange. So, but I think that the initial structure is going to remain day one very similar, and that's mainly because they are effectively, at the end of the day, if you took something like a hotel that is heavily operationally driven real estate ownership, net lease may be simpler to be able to do something of that nature, but hopefully I answered that question at least in part today.
I think we were still waiting for our next speaker to come online, so I think we may have time for just one more question.
I still have coffee. I'm good. Keep it going. All right.
So smart contracts in crypto offer a unique ability to set terms for a real estate transaction / ownership. Can you give us a good example of how a smart contract could be used?
Wow. Well, the smart contract would be have the ability to be able to utilize the blockchain capability. I think that you can have more unique tail interests into a transaction for people to leave chips on the table, even on a sale. I think that that's the first thing that comes to mind in regard to where I see that there would be an opportunity to be able to utilize those contracts and have an ability to have more joint ventures, more interesting exit strategies, an ability and that could be for somebody who's in a downside, where you're liquidating a larger portion of the deal, but still remaining with a tail interest, perhaps even in a non-operating role within that partnership, and allowing less cryptocurrency being needed to be able to effectuate the balance of the transaction. And one last thing I would say, maybe even allow for an effectuating capability of a more easier transition if there's a loan that's in place where there's an assumption capability that has something that has defeasance. So you can potentially avoid defeasance by staying in and having a more cleaner assumption over a more complicated potential even CMBS deal. We saw things, in the last downturn, which is an important factor to look at, say, how real estate transactions were able to be looked at when you looked at synthetic bonds and synthetic transactions that were out there. Crypto, and to a certain extent, is not so different. You're betting on a horse you don't own. So, to a certain extent, this is better because you at least, you're betting on a horse that you can own, but yet nonetheless with the same risk of gambling.
All right. So is there any regulation of investment into commercial real estate with coins to include syndications, also opportunity to crowdfund with cryptocurrency?
The answer is that it is riddled with governance, and you need to, again, we haven't effectuated any transactions. We have only examined and explored, and we're not pitching to do that. But I would say that our initial investigations are it's very complicated, and you need to definitely have the right team in place to make sure that you are doing everything appropriately and within the proper bounds of wherever you're going to be domiciled. So the answer is that it's yes, it's regulated because the viewpoint is that it is a security and it is an equity that you're going to be offering on the other side of it. So caution.
All right. Can cryptocurrency be used as a form of investment in commercial real estate or syndications?
The answer is that it's definitely could be effectuated. It's about the institutional support and the sizing of the transaction to do so. So that's if it's if it's a buyer and a seller, and the buyer is willing to accept its full form of payment in cryptocurrency, that's the cleanest, simplest transaction you can do in regard to effectuating it. Chances are that because a lot of cryptocurrency also are not on all major exchanges, how to access that, the trust and volatility concepts of it, it's an open question mark of what that buyer is going to deem as an acceptable form of currency. If there's debt involved, it's back to the KYC rules that bank is going to be able to most likely want to identify that form of repayment in regard to tracking that and how that's going to happen. So the answer is it's possible. Tremendous variables in regard to it effectuating itself. And this is why we haven't seen a multitude of these transactions. If anything, we've seen more fail than succeed. And I think this is a step towards bringing that awareness and that opening that discussion. Again, from somebody who is more open-minded today than I was, before, a little bit more cynically.
All right. So, So I think we have our next speaker ready.
Good luck.
Vanessa. So huge thank you to Joseph for sharing his expertise and knowledge in this space, particularly on how cryptocurrency and blockchain can revolutionize and disrupt this entire real estate sector.